Buying your first home before you're financially ready isn't just risky, it's a trap that can derail your entire financial future and leave you one unexpected expense away from serious regret. I've seen too many people do everything right on paper. They get approved, they close on the house, and then a few months later, they're stretched thin, stressed out, and one bill away from regret. So, today I'm going to walk you through the exact money milestones you want to hit before you start touring homes. This isn't generic personal finance advice. This is specifically about buying your first home the right way in today's market. Now, you can screenshot this or save it to use as sort of your checklist because the goal isn't just to buy a house. The goal is to still feel good about it a year from now. So, step one is remove the debt that makes a house risky. Before you think about down payment or interest rates, you need to get honest about your current debt situation. It affects how much house you qualify for, what interest rate you'll get, and how tight your budget will be after closing. And I do want to say this up front. We aren't Dave Ramsey over here. Debt is not a moral issue. It's about having some breathing room when, and yes, I do mean when, an emergency pops up. Now, let me be clear. You do not need to be completely debt free to buy a house, but you do need a plan to start chipping away at debt because your debt determines how risky home ownership will feel. So, first, start with high interest debt like credit cards. Credit card balances with high interest rates and minimum payments will crush your monthly budget. And here's what most people miss: credit card debt doesn't just follow you into the house, it raises the cost of that house. Next are student loans. Again, they don't have to be completely paid off, but you do need to make sure you have a payment strategy that fits your budget and long term goals. For most people, the problem isn't having the student loans, the problem is pretending that they don't even exist. If you have a high student loan balance, I get it, it feels daunting, but the good news is lenders only take into consideration the payment that is listed on your credit report, or if they're in forbearance or deferred, they'll take 0.5 to 1% of your loan balance. So, signing up for an income based repayment plan can help you reduce your payment and, in turn, reduce your debt to income ratio. The last stat I want to chat about is one I'm seeing more and more: people co signing for car loans for family or friends. Now, totally get you were trying to help someone out, but when it comes to time to buy a home, it doesn't help you. The good news is there is a way to ensure that isn't taken into consideration for your debt to income. You will need 12 months of bank statements from whoever actually owns the car, proving that they made those 12 payments directly to the car loan company, not to you. So if your mom or friend or sister have been making the payments to you and you've been making the payments to the loan company, make that switch immediately. Why does this all matter? Because debt pushes your debt to income ratio higher, and that usually means worse loan terms, less wiggle room when surprises hit, and maybe even potentially being denied for a home loan altogether. And when repairs show up, or taxes adjust, or insurance goes up, having that wiggle room is everything. Bottom line, a house amplifies whatever financial pressure you already have. It doesn't ease it. So get your financial picture in order. Step two, you want to have a homeowner emergency fund, not just a general savings. Renters call the landlord for repairs, homeowners write the checks. That shift catches people off guard all the time. Repairs are random, insurance deductibles are real, and taxes and escrow do adjust. And that first large repair isn't going to wait for you to feel financially ready. A good rule of thumb is to save 3 to 6 months of total housing expenses. If your income fluctuates a bit, aim for that higher end. Now, this fund isn't for upgrades or furniture or decorating, it's for protection. Having this buffer means you avoid panic credit card use, missed payments, and regret over purchases you can't undo should your AC go out and you need to spend $12,000, or if you get laid off and need time to find a new job. An emergency fund turns problems into inconveniences instead of disasters. Step three, you must understand the full cost of buying, but the good news is you don't need all of this money up front. Now, most first time buyers don't struggle because the house itself was too expensive. They struggle because no one explained what I call the transition period. We all focus on down payment, but it's rarely the part that hurts people. Here's what you actually need to consider before buying a home. First is the down payment, which is obvious and can range from 3.5% to 20%. Then you also have your closing costs, which can range from 2 to 5%. You'll have moving expenses, and this can be as cheaper expenses as you choose, but there will be a cost. You might choose to bribe friends with pizza and beer and use a U-Haul if you're younger, or you may opt to pay hundreds of dollars if you're older or moving when it's 120 degrees outside, like Phoenix. Either way, make sure you budget for this. You'll also tend to have immediate fixes in the home. No home is perfect, even new builds. There is likely something you will want to do as soon as you move in, like paint or install fans. If you're doing new construction, you may need to budget for backyard landscaping so your backyard isn't a dirt pit for your kiddos or dogs. You'll also have escrow and tax adjustments. You won't know the details of this until after year one, but you may get a statement from your lender adjusting your escrow account and in turn your mortgage payment to cover increases in taxes and insurance. We actually saw this happen a lot during the pandemic boom. Everyone was so excited about increasing home values, but that comes increasing taxes. And the sticker shock was real for many first time buyers who had no idea that this could actually happen. Now, you don't need to have all this cash in hand, but you do need awareness, a plan for each cost, and some margin so surprises don't turn into stress. Smart buyers handle this by sometimes negotiating seller credits, like for some closing costs, rolling some costs into the loan, or phasing upgrades over time. Now, step four, make sure you're able to prove your income is stable enough for home ownership. Now, for many, this really isn't an issue. You have a nice, stable career with stable income, and you've had this for years. Great. Easy peasy lemon squeezy. For others, you may have variable income you rely on, like commission, overtime bonuses, or maybe you're self employed. These can make getting approved a bit more complex, but not impossible. If you're in this boat, again, it doesn't mean buying a home is out of reach, but you need to know what will be needed from you. A lot of folks come to me excited after they have worked a significant amount of overtime for the past 2 to 3 months, and I have to tame their excitement a bit. Well, that is absolutely fantastic news. The reality is, a lender is going to want to see that this overtime has been consistent for 24 months, and your overtime will be averaged over that 24 months. If you've been in the job less than 24 months, then it will be averaged over the time that you've been in that job, but you still need a consistent history of working overtime, longer than just 2 to 3 months. The same is for bonuses, but sometimes you can get away with this for 12 months depending on the lender. But you also will likely need a letter from your employer guaranteeing that you get a bonus, which, in my experience, employers can be a little bit hesitant to do since they don't want to promise anything. Another aspect of ensuring you have stable income is remember that life generally has variable expenses. Some months you'll have a vacation or holidays or birthdays that increase your spending. That gap between what a computer system says your income looks like and the reality of expenses is where people can struggle. They start to have a month here or there where they are late on a mortgage payment or they skip it altogether because of these variable expenses. It really does become a slippery slope. Your mortgage doesn't really care, honestly, if your income or your expenses fluctuate. One recommendation that I have before you start house hunting is just sanity check your income by looking at the last 12 months, not just your best month, and assume there will be higher spend months or lower overtime months ahead. Build your payment around the worst case scenario, not your optimism. Step five, do what you can to boost your credit score now. Most people think their credit score is just about being able to get approved. It's not. Your credit affects how much interest you'll pay, which can add up to hundreds of dollars more a month. Good credit doesn't just buy you a nicer house, it buys you a cheaper one. I also want to make it very clear that you don't need an 800 credit score to qualify to buy a home. The goal really is to have a minimum of a 580, which is what you need for an FHA loan, but ideally, if you're able, you want to see it in that 620 to 680 range. Here's what surprises most people. Most credit damage doesn't actually happen years before buying. Many buyers actually hurt their credit right before applying by carrying high balances, missing payments, or opening new credit cards or co-signing for people too close to their purchase date. And I know this is a no-brainer, but just use credit wisely. Keep low balances and set auto pay on everything. Credit cards really should be used as tools. Remember, balances can become anchors, and timing does matter. Your credit snapshot is taken when you apply, so start cleaning it up months ahead. Don't wait for days or weeks. Now, as we chat about this, again, I'm not Dave Ramsey. I'm not saying avoid credit cards altogether, just use them wisely. One hack that I have for those looking to boost their score easily is to request a credit limit increase. Why? The more credit that you have available while maintaining the same balance equals lower utilization, which boosts your score. You can actually request these limit increases every 6 months, but be sure to only do this if you can resist the urge to spend more. I know the temptation can be real, y'all. I actually have a free guide with 6 other hacks that can help you boost your score quickly and oftentimes for free. And you can grab the link for that in the description below. Step 6, I want you to practice your future mortgage payment before you commit to it. For most of you, your future mortgage payment is likely going to be a bit higher than your current rent, especially if you've been living at home for free or you have a roommate that you've been splitting cost with. So pick your future estimated mortgage payment, and this should be a payment that feels comfortable and leaves you with breathing room. This is likely not the max amount you'll be approved for by a lender. Remember, the bank tells you what you qualify for. This test tells you what you can actually live with comfortably. If you need help figuring this number out, I have a whole video that walks you through this step by step, so be sure to check it out. Now, run a 3 to 6 month practice test. Live on that future payment now by setting aside the difference between what you pay now, put it into a high yield savings account because why not earn some money on it, and don't touch it. If the practice run feels tight, your mortgage will feel brutal. So adjust accordingly. You want to figure this out now before you get stuck with a payment that you just can't handle nor get out of. This test also reveals lifestyle creep, as I call it, weak budget margins and spending you might not have noticed. Again, you can make adjustments as needed to feel ready to take on home ownership. Now, if it feels easy, you're ready to go. And finally, the mistake that causes the most long term regret. Step 7, make sure that you're buying when it feels right for your life, not when the bank or others say that you should. Most bad home experiences don't come from bad market timing, they actually come from bad life timing. Given that the median age for first time homebuyers is now almost 40 years old, it can be easy to fall into the trap of feeling behind others around you, or that you should buy because it's the next logical step, or that it's part of the American dream. None of these are good reasons to buy. Buying your first home needs to support your life. It shouldn't require financial gymnastics to make it happen. It shouldn't block career moves or family plans. A house should add stability, not remove your options. So, what does ready actually look like? You need manageable debt, a stable income, strong credit, a buffer for repairs and those unexpected expenses, and a payment that feels comfortable, not one that stretches you thin. So, before you jump into the home buying journey, step back and ask yourself why. If it's because of external factors, wait. If it's for you, then full speed ahead. If you're thinking about buying your first home and want help figuring out whether now is actually the right time, I host a free class called Home Buying 101 where I walk you through this exact framework step by step. The link for that is in the description below. And if you're not ready for the class yet, it's totally okay. Stay here, keep learning, and be sure to check out this video next. I'm Heidi Littleton, and I'll see you in the next one.